Regulators have seized First Republic Bank, which is now the second largest bank failure in U.S. history. The troubled bank's assets have been sold to JPMorgan Chase, which acquired all of its deposits and most of its assets. This marks the third mid-size bank failure in less than 2 months and has raised questions about the health of the U.S. banking system. First Republic Bank was once the envy of the banking industry, but it has struggled since the March collapses of Silicon Valley Bank and Signature Bank. The bank catered to wealthy clients and had taken on a large amount of uninsured deposits. However, those clients with large accounts at First Republic were quick to pull their money at the first sign of trouble. The bank had planned to sell off unprofitable assets, lay off a quarter of its workforce, and cater to more wealthy clients with uninsured deposits, but it was seen as too little, too late, by analysts. In the end, it needed to find a buyer or find new forms of funding to replace the deposits that had left the bank. A coalition of a dozen banks pulled together a $30 billion funding package for First Republic last month that, for a while, seemed to staunch the bleeding of deposits. However, it became increasingly clear that First Republic was on borrowed time. The bank needed to find a buyer, or find new forms of funding to replace the deposits that had left the bank. First Republic reported its first quarter results and stunned analysts and investors when it revealed that $100 billion in deposits had flowed out of the bank, most in mid-March immediately after the failure of Silicon Valley Bank and Signature Bank. Its executives took no questions from analysts on an earnings conference call. First Republic's stock plunged more than 50% the day after the report. It became clear government intervention in First Republic was necessary. Treasury officials asked banks to submit bids for First Republic, and bankers and regulators worked through the weekend to find a way forward. Once again, JPMorgan Chase, the nation's biggest bank with a reputation as a dealmaker during times of crisis, became the government's go-to bank. The Federal Reserve and FDIC, which regulate the banking industry along with the Office of Comptroller of the Currency, could face renewed criticism over their handling of First Republic. Both acknowledged Friday in separate reports that lax supervision had contributed to the failures of Silicon Valley Bank and Signature Bank. The failure of First Republic Bank raises concerns about the health of the U.S. banking system. It's important to monitor the situation and keep a close eye on other mid-size banks to prevent similar situations from occurring.